So you want to become a real estate investor. Whether you want to flip some houses or build a massive real estate portfolio, understanding these key terms is an absolute must. I'm going to go ahead and break down 7 real estate terms that every real estate investor needs to know. Okay, before I dive into it, go ahead and drop a comment on why you want to become a real estate investor. First one, net operating income. Net operating income is basically going to tell you how much money an investment property is going to make you. To calculate your net operating income, you're going to start with your total income and you're going to subtract your operating expenses. So when you're looking at the income piece, make sure you're including all of the income streams, right? If you have paid parking, if you have a washer dryer unit in there. So yeah, just make sure you include all sources of income. And then when you subtract, take away the operating expenses and don't include expenses like mortgage payments. And so why is net operating income such an important metric? It allows you to really look at the income that this investment property is going to be generating for you. It shows you basically if your property is being well utilized or not. Also, this is going to allow you to figure out, is this deal actually a good deal or is it a bad deal and should I pursue it? The second term that every real estate investor knows, capitalization rates, aka cap rate. And so cap rates are typically used to estimate the potential returns and gains on a property. To calculate your cap rate, you're just going to take your annual net operating income, and that's going to be over the cost of the asset or the current value. So you're going to divide NOI over value. Why is cap rate so important? Cap rates are a very common term used because they're a pretty good indicator of like your expected returns and the risk involved with the investment. And so normally a higher cap rate means it has a higher prospect of return, but usually a higher risk as well. Lower cap rates typically imply a lower risk investment, but also lower potential returns. So cap rate is also used to compare, when you're comparing 2 properties to invest in, cap rate will be one of the metrics you look at to see which one might be a better deal. Term number 3, cash on cash return. So the cash on cash return looks at the total amount of money you've invested in the property and calculates the total return you're earning from the investment. So you're probably wondering, how do I calculate cash on cash return? You can look at it on a single property or you can look at it for your entire portfolio. But basically, you're going to divide your net cash flow after debt service by the total amount of cash you put into the deal. When you look at total cash you put in the deal, you're looking at the total amount of what you spent to acquire the property or the portfolio. This doesn't just include the cost of the property, but it also includes the closing costs. So why is cash on cash important? Once again, it's a metric you're going to use to compare different potential investment properties. Not only is cash on cash a metric used to compare properties, it's a good forecasting tool, especially when you're doing improvements to a property you already own. If you think this video has been helpful so far, go ahead and subscribe, and I'm going to continue making real estate investing videos. Back to the terms. Term number 4, loan to value ratio, LTV. The loan to value ratio measures the equity you hold in a property or your portfolio, and it also allows you to assess the value of your portfolio while taking into consideration the amount of debt you have. LTV is also an important finance term because when you're buying a property, this formula basically expresses how much needs to be financed compared to the property's current fair market value, right? If you look at the calculation here, it kind of shows you what LTV is. And LTV is a very important term because this is basically how lenders are going to lend on properties. There will be certain LTV requirements when you purchase a property, aka you're going to have to put a certain amount down, and that will change your rate or the type of loan products available. And so I'll just walk through a really quick example, right? So if you plan to buy a property for $200,000 and the lender offers an 80% LTV, it means your down payment must account for the other 20% or $40,000 in this specific scenario. It's not uncommon with certain types of loan products, especially for investment, to see a minimum LTV of 75 or 80%, meaning you're going to need to bring 20 or 25% down payment to purchase the property using their investment loan. Term number 5, ARV, after repair value. So ARV is a really important term in real estate investing because it's basically the estimated value of a property after all the repairs and renovations have been complete. ARV is used for multiple reasons, right? The number one is investment decision, right? You're gonna buy this property based on the potential ARV, right? When you're flipping, when you're buying a rental, you're buying based on the upside of the property, which would be the ARV. It's also important for financing. A lot of people will buy a property as a fixer with the intent to hold it, and then they're gonna refinance after they renovate it because the value will be higher and they can keep some equity in the property, they can pull some cash back out. Another reason why ARV is so important is because it affects your exit strategy. So let's say you're potentially flipping a house, you want to make at least a $50,000 profit, you're going to need to have a very good idea of what that ARV, after repair value, is and what you can sell that home for to give you an indication of how much you can buy the house for and how much the renovations can cost. And so you're probably wondering, like, okay, how do I calculate ARV? So calculating ARV is more of an art versus a science, right? You're going to look at the recently sold properties nearby. You're going to do your own market research. You're probably going to bring in a local market expert. You can call real estate agents, brokers in the area, and you can get their assessment too on what they think the ARV is. Term number 6, debt service coverage ratio, DSCR. So DSCR, the debt service coverage ratio, basically measures the ability to pay back all of the debt obligations with operating income. And so to determine your DSCR, you're going to divide your net operating income by the debt payments. And you can calculate this ratio on a monthly, quarterly, or annual basis. So why is DSCR so important? This ratio communicates your ability to repay a loan. This is probably the most important consideration from a lender whether or not to approve you for a loan. And so if your debt service coverage ratio is less than 1, you probably won't qualify for financing because they're going to see you as risky and over leveraged. A lot of lenders are looking for a DSCR over 1 and somewhere between 1.25 and 1.5, right? This range implies that you can service your debts and your properties are generating at least another 25% of income beyond the cost of your loan. So in summary, right, like a higher DSCR might actually improve your interest rate on the loan because it shows that you have this strong ability to pay the loan back. Term number 7, I think everyone knows this one already. Cash flow. Cash flow is one of the most important metrics to real estate investors because it basically shows how well your business is doing. Your cash flow is the net cash you have left over at the end of the month after all your expenses have been paid, including debt service. I'm sure many of you that are interested in real estate investing are getting into it for this specific reason. Additional cash flow, right? You want the mailbox money. You want the money that you own the property, you've done the work, the upfront work, and now every month you're just collecting checks. And so obviously monitoring your cash flow is really important because this is a main piece of why people invest in real estate. So I hope these terms helped you understand real estate investing. I hope these are like the gateway for you to get into it. If you're ready to take some action, go ahead and email me and I can send you either a flip calculator or a rental calculator that I use when analyzing properties.